Hello everybody, this is Ignatius L. Jackson CPA here with the nice little tax tip regarding selling your real estate. So that's what I want to talk about today. So recently posted a couple of articles on LinkedIn in regards to owning and selling real estate. So there's one article in regards to how you're treated as either a dealer or an investor, and which is a key component to also determining what you end up having to pay when you actually sell the piece of real estate. And so that article also talked about entity structure as well. When you're going to buy and own real estate, there's definitely certain ways that you should own that real estate, depending on what your purpose and intent of the transactions are. So definitely take a look at those articles. They've got a lot of good information in there. But in general, just wanted to kind of touch base on a couple of points from the articles. First and foremost, in terms of structure of your entity when you're buying real estate, you should never put real estate into an S corporation or a C corporation. Okay. Reason being is when you want to go in, do anything with that real estate, like sell it or get rid of it, or maybe even transfer it to your name, it creates a taxable transaction that is virtually impossible to get rid of. And so you definitely just want to make sure you don't put your real estate into a corporation, whether it's an S corporation or a C corporation for tax purposes. And that would include an LLC tax as an S corporation or a C corporation. So that's definitely one key point from the article. And in terms of being a dealer versus an investor, really the key difference between the two would be payroll taxes. Okay, so if you're a dealer, you end up having to pay payroll taxes. If you're an investor, you don't have to pay payroll taxes on the activity from that property. So definitely some things to consider in that article, in terms of how you get classified from a tax perspective. In terms of the second article that was recently posted as well, what happens when you actually sell the real estate? So when you sell your real estate, there's a couple different things that could occur, depending on how long you held the property and whether you're an investor. So if you're an investor and you've held the property for longer than a year, you can basically get a long-term capital gains rate, which is anywhere from 0 to 20%. So 0%, 15%, and 20% are the three rates. And so you'll get that kind of a treatment. If you did take depreciation on that investment property, let's say it was a rental property or something like that, you would have to do what's called depreciation recapture, which is paying a certain percentage higher than that capital gains rate on that sale. If you held the property for less than a year, you would have to pay ordinary income taxes on that property when you sell it. And if you are considered a dealer, again, you'll end up paying payroll taxes on top of ordinary income taxes. So definitely some considerations in that article as well. Some other things that we talked about would be Section 1031 exchanges. So when you're selling the property, you have the option of doing a Section 1031 exchange. What that basically means is you identify another piece of like-kind property and you essentially exchange it for it. So the downside to that though is you have to keep all of your investment in the properties. So if you sell one property to buy a new property, you cannot receive any cash. Otherwise, you do end up paying taxes on the portion of the cash you end up receiving. Definitely a lot cleaner if you just do a straight exchange rather than a partial exchange. So definitely consider that if you're thinking about a way to defer some of those taxes. Another method that you could use is called the installment sales method. What that basically means is you're owner financer. So you can owner finance a property and you actually only pay taxes on the appreciated gain based on a portion of the principal payments that you're receiving. So over time. Now that strategy is only available to people that are considered investors rather than dealers. And so if you're a dealer, you unfortunately can't do the installment sales method. If you're an investor, that's something that's available to you. There's some exceptions to that rule, but generally speaking, that's kind of how that works. And then one last point that we had talked about was qualified opportunity zones. Qualified opportunity zones are a newer strategy, but potentially very, very beneficial strategy. So something to definitely consider in terms of how you're going to structure the sale of your property. You can basically reinvest your capital gains portion only, meaning, if you have some additional cash that comes to you that's not considered a capital gain, you can basically utilize that cash and kind of do whatever you want with the sale. And so in a qualified opportunity zone, you ultimately get to reinvest that capital gains into what's called a qualified opportunity fund, and that fund then invests in either properties or businesses that are within a qualified opportunity zone. And as long as it does that for substantially all of its assets, then you, as an investor in that fund, would receive a significant tax advantage. So the first advantage would be after 7 years, you get a 15% reduction on your capital gains tax amount. So instead of paying 100% of the capital gains tax that you ordinarily would have paid, you only have to pay 85%, and the rest of it just kind of vanishes in thin air. You never have to pay that at any point in the future. And then after 10 years, if you hold all the cash in there for 10 years from the capital gains, you also will get 100% tax-free distribution, essentially, on any additional gain from that investment. So, to put that into perspective, you put $100,000 of capital gains into a qualified opportunity fund. At year 7, you pay whatever that 85% of whatever that tax rate is on that transaction. At year 10, let's say you made another $100,000 in profit from that investment within that fund, and you get paid out a total of $200,000 at the end of year 10. That comes back to you. $100,000 is your initial investment for that capital gain that you put into it, and the other $100,000 is considered an additional gain. Well, guess what? You don't pay any taxes on that additional gain as long as the fund was operating properly and you held the investment in there for that 10-year period. So definitely one of the few ways that you can make money in our tax code and not pay any taxes on the money that you're making. So definitely something to consider when you're out there selling real estate. And so we're here to help you. Obviously, we at Ignatius Hill Jackson CPA, we like to help small business owners and real estate investors to help you strategize and save money on your taxes. Right now is a perfect time to be planning for your taxes this year. You don't want to wait until January or February because that's too late. There's a lot of strategies you can put into place, but they have to be put into place by the end of the year. And so you definitely want to make sure you're out there talking to somebody. If it's not us, then definitely reach out to a competent tax advisor and start planning out what you're going to do for the end of the year to get your tax liability down to a reasonable level that you're satisfied with. There's definitely a lot of strategizing and planning we can do, but again, if you wait until January, February, March, April, anytime thereafter, right, the options significantly decrease, and the options that you have available to you are not necessarily that great. So a lot of the beneficial tax strategies and treatments you need to start planning now. We're doing a special right now. We'll do tax planning for you for $100 per hour. So if that's something that you're interested in doing, most smaller individuals, we can do a tax planning and tax strategy session with you. Within a couple hours, you'll have kind of a plan of attack. We'll be able to explain to you exactly everything that you kind of need to do. So it's worth the couple $100, maybe even $500, depending on how more time sensitive. I shouldn't say time sensitive, but how difficult it is to kind of get you what you need. But definitely something to consider. If you haven't ever talked to a tax professional, definitely something to consider. If it's your first time ever talking to us, or you're not a current client, we also offer a 1 hour consultation for $75. So if you come in, we'll chat with you for an hour and just kind of give you some perspectives and thoughts, get to know us. And then after that hour, if you decide to engage us for some additional work, then we'll credit that $75 to that additional work to where you get that first hour essentially for free. So definitely some stuff that we have going on here. Nice little special this time of year to do some tax planning for you. So give us a call. If you need some help, give us a call. 480-542-0404 is our phone number. Our website is iljcpa.com. Again, 480-542-0404. Website iljcpa.com. And hope everybody has a wonderful day, and hope you enjoyed this nice little tax tip. Definitely go out and read the articles, and hope to hear from you soon. Have a good one. Bye.